You're watching Investor's Guide on ET Now. Thank you for tuning in. I'm Fee D'Souza. What's happening in our market right now? Well, we're waiting for election results, and volatility is the name of the game. Also, if you believe, like most of our other analysts, that interest rates are going to come down over the course of this year, then investing in debt funds might be the thing to do. Don't worry if you didn't understand any of that. On this show, we'll manage your money and we'll tell you where you should be investing all of it so you can profit over the long term. Write down my email ID. It's at the bottom of your screen. Send in any question you have about investing, saving, or spending your money. On the show this week, we'll help an NRI streamline his portfolio and plan for his future. In our product review, we look at the SBI Magnum Multiplier Plus plan, and we'll tell you how you can beat the fixed deposit and get better returns over the next year. It's time for me to bring in Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Well, Tapas Datta writes in from Dubai. He's 41 years old. He has 2 young children that he wants to plan for. He began investing in equity this year. His goals are to create a corpus for both of his children. He has a son and a daughter. He wants to plan for their education over the next 6 to 13 years, respectively. He also wants to create some corpus for their future, for his own retirement. He tells us in about a decade from now, he'd like to retire with a monthly income of 1 lakh rupees. Now, I want to take his entire portfolio piece by piece, Dhirendra, because he's been kind enough to send us a lot of information so we can give him a good answer. And he does have a fair amount of money across various asset classes. So I think what we really need to do is help him organize his money. Let's start, like we always do, with his insurance. A term cover of 50 lakh rupees, an accidental disability rider of 1 lakh rupees. That does not seem enough at all, given the kind of money he has in savings and the fact that he has 2 young children who will soon be going to school and college to higher education. He's also put his money into a ULIP, which seems like a fairly expensive ULIP. It's the Lifetime Assure plan from ICICI Prudential. Let's first only look at his insurance needs, Dhirendra. Does he have enough? Would you like him to relook at all of it?
There are 2 ways of looking at it. One is that he has enough. If you look at his cash balances, if you look at his property, or if you look at his investment, accumulation, he has enough. But his property component of his net worth is not a liquefiable thing, or it may not be a liquid thing. He has a sizable cash balance right now, but once it goes into acquiring the property, it may not be liquid. And from that, and if that property is going to be the house in which you plan to live in, then it's not a property. It will become your home, and it is not a liquefiable asset. From that standpoint, so he should take a call whether these assets which he has accumulated, if they are for consumption, or they are assets which can be sold off, or can be liquidated if the need be. Then he doesn't need the term insurance. And the insurance policy that he has are the most expensive ones, are the most undesirable ones. In fact, the accidental insurance is a very cheap policy. And that is something which he should retain. And my sense is that the premium for that policy will not be very high. It will be a very nominal sum. But he should do some estimation and get a supplementary term cover if he thinks that his assets are not, that is a component of his net worth which is not liquefiable or cannot be liquefied. Then he should go for adequate term cover.
Let's look at his debt investments right now. He has about 45 lakh rupees in his NRI deposit. He also has property worth 1 crore rupees, and he wants to spend another 6 crore rupees that he has in cash right now on more property. Now, if he's only looking at it as an investment, would you rather that he diversify that money across other asset classes as opposed to just real estate?
If that is going to be a property, then he should reconsider because if he's an NRI and he's going to buy a property here, the manageability of it will not be easy. But looking at property today, when I look at it very realistically and with great objectivity, I find that it turns out to be a lousy investment if you are going to hold it for a long period. I don't see the rationale for it. The rental yields on high-end property could be very low. The whole hope is about appreciation. Then it becomes an asset like gold that, there will be another person who will be willing to pay a higher price at a future date, and which will actually bring down the yield lower. So last 25 years may not be, extrapolated to the future, the next 25 years that we're likely to see. More so for a house of a different ticket size or the complexity of such transactions, when I see in India the way it is executed, owned, and managed and maintained.
All right, Tapas, so this is the advice you're getting. If you're going to buy a home that you want to live in when you retire, then it makes sense. If you're considering investing 6 crore rupees purely as an investment in real estate, then it might make sense for you to consider to diversify that money in the very least. Dhirendra, let's take a look at his mutual fund holdings right now. He has about close to 60 lakh rupees invested in mutual fund. Not all of it is in equity. He also has some funds that he stopped his SRPs into, and an additional investment of about 20,000 rupees every month that he'd like to put aside. He's currently investing 1 lakh. Now, he has the ICICI Prudential Dynamic UTI Opportunities, Birla Sun Life Frontline Equity, Focused Blue Chip Equity, IDFC Premier Equity, and ICICI Prudential Discovery. Now, these are all your recommendations. Should he just continue with these funds?
Yeah, I think so. And, I think he should, given his scale of financial net worth, his equity portfolio should be simpler and larger, much bigger. And he should consolidate his large, and he also has, about 13 lakh invested in equities directly. There I would like to point that, if he's managing it proactively and he enjoys doing that, he should carry on. Otherwise, he should move that money gradually to mutual fund. At least it will be attended to. And it will be easy to, it will be cared for compared to, a passive investment in equity, which people tend to make and forget. And I would imagine that, the amount of money which he'll be able to realize by liquidating his ULIP policies, the amount of money which he has in fixed income funds or the MIPs and other things, he doesn't need that. He should work on a very simple plan, work on the term cover. He should care about his health insurance for him and himself and family, have the emergency fund, and a large one at that, because, looks like he has, plenty of cash surplus lying idle. So he can have a large emergency fund, and rest of the money, which he's unlikely to need for next 10, 15, 20 years, except for the money which he is likely to, need for buying a house, should methodically get into equity.
All right, so very clear advice there, and this is advice that we normally give to anybody who writes in on this show. You have to have an emergency fund, health insurance, life insurance, and of course invest the rest of the money in equity. And of course, I'm going to shamelessly quickly plug this show as well. We have a show called The Property Guide on ET Now that plays at these times, India times, on this channel. So if you want help in looking for a house or finding property, write to us on that show and catch that show over the weekends as well. Let's take another question. This is from a woman investor. Kirti Kumar has written in, Dhirendra. She's been very kind. She tells us that she finds this show most helpful, which is why now she's motivated to wake up very early on Sundays and Saturdays and watch our shows. Now, she's invested in the HDFC mid-cap opportunities, both in the dividend and the growth option. And after watching Investor's Guide, she realized that she now needs to switch to the growth option. She tells us her last dividend was in February 2013. She wants to know now, should she wait for another dividend announcement, or can she switch now? Will it make any difference at all? What's your advice for her?
No, it doesn't matter. She can switch anytime. Because, the relevance of dividend from a mutual fund is virtually nothing. Because assuming that, this fund's NAV is 100 rupee, and tomorrow it is going to give a dividend of 10 rupee. So if she is able to redeem that money and move into the growth plan, she'll be able to realize 100 rupee and invest it there. Tomorrow, after the dividend, the NAV will become 90 rupee and she will have a 10 rupee check. That's all the difference that there will be to it with the dividend. So it makes absolutely no difference to your return. The only thing to worry about is that in your dividend plan, if you have invested, and if that investment is less than 1 year old, any gain that will be there will be liable for short-term capital gains tax. So just defer your redemption.
Well, Narendra has written in, Dhirendra. He tells us he redeemed money from his HDFC Top 200 investment and received a return of 14%. Now, he wants to now invest this money along with 4,000 rupees every month in an SIP in a new fund. And he wants you to give him some options for a 3-year time horizon. Now, I wouldn't have wanted him to pull out of HDFC Top 200 at all, but he's already done that. Now, what can we do to help him, Dhirendra?
Ideally, he should not have pulled out. And it doesn't make sense. And that 14% return, today, what has happened to this fund in the last 6 to 7 weeks, with a little change in sentiment of the market, or the changed complexion of the market rise, returns would have been very different. And so a lot of people were getting disappointed or disenchanted with HDFC Top 200. It is among the largest fund. and it was a laggard with its 20% allocation to some bank, PSU banks and other things which was not working or which did not work out very nicely for the fund. But suddenly it has made a huge comeback, and now the numbers look very different. So again, the lesson to be taken from his action is that don't get impatient with your equity investment, and 2 year is not good enough time period. You are trying to perfectly time it with the market, and 3 years is not a good enough time frame. At best, I would say that consider conservative balanced fund. You are assuming you are taking some, but even there you are taking some chances with equity, and 3 year period is not good enough.
So, Narendra, like we always say on the show, a 3 year period is not good enough to invest in equity. And before you pull out of any fund, write to us. That's why we're here. We'll help you. We'll tell you whether or not you should. And in this particular case, like Narendra said, you shouldn't have pulled your money out of HDFC Top 200 because the fund in the last couple of weeks has actually, in fact, recovered like we have been telling you that it would. We're going to take a very quick break. Coming up on the other side, Narendra is going to stay with us. He's not going anywhere. We're going to talk about the SBI Magnum Multiplier Plus Fund. It's a low buzz fund. We'll find out, though, what its performance is like. Welcome back. You're watching Investors Guide on ET Now. It's time to look at our product review. And this week, we're looking at the SBI Magnum Multiplier Plus Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. This week, our fund in focus is the SBI Magnum Multiplier Plus. Let's take a quick look at its track record. The fund, which was launched in 1993, is one of India's oldest equity funds and has managed to clock in strong growth under Jayesh Shroff's leadership. Except for 2008, when the markets were volatile, and in 2011, the fund has consistently outscored its benchmark index, the BSE 200. Currently, the fund is ranked at an impressive 6 out of the total 69 funds in the category. The fund's top 3 sectors are financials, technology, and healthcare. On a year-to-date basis, the fund has generated a return of 7.38% against the category average of 7.71%. So let's bring in some numbers to get a better outlook of the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 10,426 rupees today. So is this fund a good bet, and should you add it to your portfolio? Let's find out. With that, it's back to you, Faye.
Avan, thank you for that introduction. Narendra, I want to bring you in here. Now, the SBI Magnum Multiplier Plus Fund, one of the oldest equity funds in our market, and it's not really a high-profile fund. It's not a name we hear on a regular basis. But over the last 5 years, its performance really has been excellent, given the market that we've been in. Are you impressed as well?
Yeah, I'm very impressed with this fund. In fact, this fund has been conducting right for last 4 or 5 years, and looks like it is bearing fruits now. It is among the oldest fund, but the first 10 years, it has been a very erratic fund. It used to be a very high-performance fund on occasion, but it used to be very erratic. It used to change its color depending on the time. There was no consistency of, or the fund did not have a very well-articulated strategy that what it will do at all times, at what investors should. And it started as a closed-end fund, as a 7-year term closed-end fund initially in 1993, and then got converted into an open-end fund. And even after that, for a long period, it did not have a stated, well-articulated framework to operate. But now it looks like it has, and that seems to be working. Last 4 or 5 years, it is conducting in a very predictable way. It has been in the same category, and it has a portfolio of known names, and also backed by great performance. But yes, this fund is presenting a compelling opportunity, or a very attractive proposition today.
All right, so it's a good fund. When those of you who are invested in this fund, Narendra is saying that it's an excellent choice right now. Narendra, the last time we reviewed this fund, you gave it 4 stars. Where would you place it now?
I will place it at 4 star. But the other impressive part is that it has, if you look at the component of our risk-adjusted rating scale, it's with a above average return, with a below average risk scale, which is ideal.
On your screen right now, the SBI Magnum Multiplier Plus Fund, above average return, below average risk. It's really something that we all look for in a fund. Write to us if you have any questions about the review that you just heard. Let's move on now to our extremely popular hold or sell segment. 27-year-old Rahul has written in, Dhirendra, he wants to create long-term wealth and he started investing in mutual funds 2 years ago. Now, he wants to know if his investments are on track. Let's take a look at his funds. First up, Franklin India Blue Chip and ICICI Prudential Focus Blue Chip. 1,000 rupees every month into both of these funds. They're excellent funds. But for a 27-year-old with a long-term view, does it make sense?
Yes, both are, the best choice one can have in the large cap fund universe. But for a 27-year-old who is looking to, maximize his return over a very long period of time, this may not be the best choice. The whole, this kind of fund may not be the best choice. So, he should look at, multi-cap funds where the fund manager will have all the flexibility.
Well, the next fund on his list might just be one of those funds. He has HDFC equity, and there's a larger amount of money going into this fund. He has 2,000 rupees going into HDFC equity every month. Continue this fund, Dhirendra. Is this what the doctor ordered for him?
Yeah, it's exactly the kind of fund which you should have because, HDFC mid-cap, HDFC equity, if you look at it, it is a combination of, large cap as well as mid-cap stocks, and the fund manager takes care of it.
Let's also take a look at his mid-cap funds, Dhirendra. HDFC mid-cap opportunities, 2,000 rupees a month. And of course, he also has the DSP BlackRock micro-cap fund at 2,000 rupees a month. Continue both of these investments as well?
Yeah, they are the finest choice among, they both are excellent funds. And combined together, it makes a, I would say that they are, both the funds have potential to be multi-baggers over, if held for a long period of time. And more so in case of HDFC mid-cap opportunity. But he has to be aware that, this is the kind of fund which will be very volatile.
Let's take a look at the last few funds on his list, Dhirendra. He has the Kotak Bond Fund and the Kotak Gold Fund. Now, for someone with his time horizon, I already know what your opinion is going to be about the Gold Fund. You obviously don't recommend it, but what about the Bond Fund?
I think Bond Fund, every fund, every portfolio should have a fixed income allocation. Because if you look at it holistically, it provides you the stability. The other reason why you should have it is that you should be able to periodically rebalance.
Would you like him to make any more additions to his portfolio? Because now he's left with HDFC equity and 2 mid-cap funds. Is there anything else he can add to this portfolio at this point?
Yeah, if he's actually going to drop his 2 large cap funds from this portfolio, then he can well substitute, with, one more fund like HDFC equity and something which will be spreading across the whole market. At the same time, has a slightly different approach. It won't be as growth oriented as HDFC equity. Then I would say that a meaningful fit will be ICICI Prudential Dynamic Fund. All
right, add the ICICI Prudential Dynamic Fund to your portfolio. If you'd like to have Dhirendra look at your entire mutual fund portfolio, write to us. Email ID is on your screen. Dhirendra, thank you so much for answering our questions on the show this week. Look forward to having you back again next week. Coming up after the break, we'll tell you where you should invest your money if you want to beat the fixed deposit. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We brought in Gajendra Kochari this week to answer the questions you sent in on asset allocation. Gajendra, thank you so much for joining us. Our first question comes in from Bikram. Bikram writes in saying he wants to invest 10 lakh rupees with a time horizon of 2 years. He wants to use the money to construct a home. Where can he invest this money right now to get good returns, better than a fixed deposit? So the great part about this question, Gajendra, is that he already knows exactly what his time horizon is. What would you recommend he does with that money?
Fair for Vikram, I would suggest equity funds may not be a good idea for him because he has a very shorter term time horizon. So fixed income funds would be a better option wherein he can expect to get better post-tax returns compared to fixed deposits. And these are more safe and more steady, and he can withdraw whenever he wants because liquidity is also available. So I wouldn't suggest him to go with the equity funds. He can choose to stay invested in debt funds. If he has little more risk appetite and has 3 to 5 years horizon, then at the best he can go for asset allocation funds such as DSP BlackRock dynamic asset allocation funds, which can give him very consistent performance over a 3 to 5 year time horizon.
Our next question comes in from 33-year-old Adit, who writes in saying he wants to begin investing in mutual funds. He wants to know if there's a website, Gajendra, that you can recommend that he looks at right now to understand the different types of mutual funds and, of course, which one will give him best returns. Well, Adit, apart from just looking at what will give you good returns, I'd advise you to also carefully look at the kind of risk each mutual fund brings, and each of them has a different risk. And when you understand that, it will make investing a lot easier. Gajendra, what would you recommend he does?
Faye, I would like to congratulate Adit for thinking for starting out on mutual funds, because that's a very good investment vehicle for anybody to start planning for the longer term. Since he's not aware about mutual funds, the first step he should be doing is finding what are mutual funds and how they benefit and what are their taxation implications. And the best way to get started is go to the AMFI website, which is the body for mutual funds in India, wherein you'll find a lot of material like investor's guide on how to start with mutual funds and other things. He can also go to many different AMC's websites, and wherein each mutual fund has a lot of investors education material put up on their website, which is either in the form of video, audio, cartoons, and he can get acquainted with the whole product, and then he can start slow. So I would recommend him to start with something like debt funds, which are safe to feel the experience. He can start with liquid funds, and over a period of time he can gradually go to equity funds, balance funds, depending on his risk appetite and his time horizon. And if he wants to invest in tax saving funds, so I would suggest him he can go with Franklin India Tax Shield Fund to start with. And if he's looking for a diversified equity fund, then he can go with HDFC Top 200 Fund, which has again a very decent track record over the longer term. So he can choose one of these funds, but he should be aware that these funds are equity funds, and he should have at least 5 years horizon to see the funds giving him decent returns.
Last question of the show. Prasanna writes in. Now he tells us he wants to make some tax saving investments for the year. He already has about 30,000 rupees going into a ULIP, 50,000 rupees going into his PF. That leaves him with 20,000 rupees ideally in his ETC, but he wants to invest 40 or 50,000 rupees in an ELSS. Now Prasanna also tells us that he invested in HDFC in various equity funds and he's not satisfied with the returns on his investments. Prasanna, before you lose heart entirely, I'd like you to this week take a look at your investments one more time. Those funds that you're talking about have recovered quite substantially over the last few weeks. Now, Gajendra, let's take a look at what he needs right now. He needs an ELSS to invest for this year. What would you recommend he does?
Faye, for Prasanna, I would suggest he can choose between the following two tax saving funds. One is the Franklin India Tax Shield Fund, which invests most of its money into the large cap stocks, and the second option is a DSP BlackRock Tax Saver Fund, which is a kind of a multi-cap fund. Again, has a decent track record in the past. He can divide between the two funds either 50-50 for his 40 to 50,000 rupees investment. He also mentioned about his HDFC funds, which he said he's not very happy about its recent performance. I would just like to advise Prasanna that short term, 3 to 5 years is a very short term to look at the funds of equity, to look at equity funds, and particularly HDFC Fund House has had a good long term track record. So just last 3 years has not been their way. So I would rather suggest you to hold on, and I'm sure the performance will come back.
Thank you for watching Investor's Guide. Remember, email ID is on your screen, Twitter ID is on your screen as well. It will be my pleasure to hear from you. Get in touch. Tune in next week to catch the show.